Now then guys, video 3, this is the Forex crash course. So we're going to be going into the main markets, what Forex basically is, commodities, metals and stocks, which is sort of traded the same usually as Forex. Similar styles. Then we're going to go into the trading styles, so the fractal nature of the market, we're going to learn what that means, looking at time zones. And yeah, that's pretty much it. It's just a real basic crash course, get you into it. So, all right, let's pop up trading view. So I'm going to clear all this stuff. We'll go back to daily. All right, so the foreign exchange market is basically the price of one currency over another. It's a little bit different to stocks or crypto in the sense that you're not going to be it's not likely that you're going to be buying a currency to hold it unless you're buying absolute billions. It's primarily for trading and exchanging based on basically exchange rates of the currency. So this is the price of the euro over the dollar over time. So we can see if we zoom right out, we're in a downtrend. So at any one point, if you bet on the market, obviously there's price before that, but I don't know where it is. It's a dinosaur there. Yeah, price has been decreasing over time. So if you bet on this market at any one time to go down rather than to go up, you can see the general trend is down. Okay. So the main markets which are currently traded on are euro over the US dollar, so dollar pairs, Aussie dollar over the US dollar, Great British pound over the US dollar, and then there's more exotic pairs which are, like for example, the pound over the Japanese yen. There's 35 or 36 Forex pairs, I forget the exact one. It doesn't really matter too much for our purposes. And basically what we can do is bet on price of movements going up and down. The thing with Forex is we believe it's run by an algorithm, and banks and large institutions basically are on the other side of trades which most normal people or retail traders, little fish, are on. So what we're essentially trying to do is just bet on the market based on techniques of previous patterns. Oh, excuse me. So at the minute, each one of these candles represents a week. If you haven't got trading view by now, you need to get trading view. You can get a free one. It's pretty good even on the free one. You get access to most time frames. So if we're looking at trading the market, if we think, for example, and usually what you're doing when you're trading a market is you're betting on that price or that place where you're entering to be an edge of the market. So we're expecting an edge of the market. Get rid of all this. We're expecting the edge of the market, the price to come into that area, not go above, say, a certain other area, and then we'd like it to move down until we're happy with our rules. Everyone's rules are different, and this is where trading strategies and things go into. So, for example, if we bet on price, so we looked at this price action here, like that there. If we looked at that and we think, right, that's probably going to come up to about halfway, or reversion to the mean, regression to the mean, roughly, if you look there, that's roughly about halfway. Price often comes after movements, at least to the 50%, and then we can bet on it going down. So if we got in there, we're expecting the price to come in, and this is basically how you make money over time. We're expecting price to come in, not go above there because we'd lose our bet, but then we want it to come into here somewhere and then start to move off, and then we can close the position when it's hit our rules. or we're happy with where price has gone just there. All right. So, yeah, basically, that'd be an example of a short trade. The thing is, though, if we look here, if we were expecting this trade, so from here, when this price starts to reverse, we had this trade on, we entered here, that were how many days? 12 days, and then we had to wait for 104 days to take our profit. Yeah, obviously we're only taking one trade in that time. So if we've got a 10 grand pot, we're risking 1%. So we're risking 100 quid. It's taken us, how many days were that again? It's taken us 104, 107, whatever days to make 500 quid, which no one's going to get rich on. It's peanuts. So, for example, you could have a trade like that, what you're expecting to run, if it comes into a higher time frame area. So say you got in this trade here, you're expecting price to move roughly to here and then regress back down. A technique of this long-term trading, swing trading, whatever you want to call it, major moves in the market is a tool. So say there and not beat this, we thought that was the top, could cover it. You could leave a long-term trade like this running over quite a long amount of time, depending what type of account you've got. Yeah. So you can make quite a bit of bank over time. But then the other swings and the other trends, you could pop on other positions, though. Say, for example, that we don't think that's going to get beaten. Halfway in there, just real simple stuff. We could have another trade running here, and we could take profit over there somewhere. Yeah. So that's the longer term trading, and that's what anyone could essentially do. It's similar with buying stocks and crypto in a way, but the only way you could really make money on that, unless you know what you're doing, is effectively buying somewhere. You'd sell off if it starts to reduce by too much money, and then you can ride the wave up if we're expecting a return back up. Right, so obviously we can't all trade like that, but we need to know the longer term, the higher term trend. So for example, here Euro has flipped on the daily time frame, at least it's flipped potentially bullish. A high has been broken with a full body candle, and if this continues, it's sort of confirming more and more that the trend has changed a little bit, so we can expect some of this and then maybe return that in the longer term. So at the minute we are bullish on Euro, but we've got to be mindful of which other zones we are in, which we may see reactions from, which comes into actually learning what you're doing. All right, so if we were trading on different time frames, so we were trading on like a weekly time frame, so we want to open and close the trade within a week, you know, so like this sort of time frame here, we could be expecting and waiting. Usually what you usually do, most of your trading is quite dull, and it's actually just waiting for price to come into areas where you'd be interested in basically taking a bet on it based on what it does on the smaller time frame when it gets in there. So say we wanted to cover that and we want to trade within a week, we could take one trade in the week. It could be wrong or it could be right, but if we have a winning week there and we take our 1 to 9, that's where you're laughing. All right, so yeah, there's your 1 to 9, but we could get it wrong, take a loss. That's the thing. So the thing is, the lower the time frame you start to trade on with respect to where the higher time frame trend is. Yeah. Basically, you can take more trades. So if we're on an hourly time frame, we have more opportunities to play reactions in this case. So if we're looking at, I can't really go too much into the strategy and things here, but for example, if we're expecting like this to be a reaction, we could take a long in here, we could take a long in here. If we're looking at short positions, we could think this might be a significant area or a short position from somewhere in here, reaction from, and then start to take positions down. So over the couple of weeks, we could take more potential trades. Some might be stopped out. Like the thing I was trying to get short in here and stopped out. It's wrong. Yeah. So basically, the lower the time frame you trade on. So if you're a day trader, a common one we use is the 15-minute time frame, and obviously there's 4 in an hour times 48, so there's 96 data points within a day. We get more idea of where the day's going. Yeah, so basically in the day, if we are day trading, where is the session? Yeah, so when the market's opening and closing, you've got to think this is a 24 hours but 5 days a week market. So it's going to open Sunday night, it's going to close Friday night. But basically, different time zones throughout the night. There's different sessions. So Asia for people in the UK is overnight, and then we come into the London session, London Open. I don't actually know. This seems a little bit off, maybe. I don't know about that. I'll have to have a look into this. But yeah, basically, this is weird. New York is. I'm gonna have to look at these times. I think that's completely wrong, actually. Ignore that. But yeah, basically, if there's an Asia session, that's overnight, and that's got its own sort of rules and things what you might want to look for. London and New York have got their own characteristics. If you think all the bankers and everyone's opening at like 8, 9 in the morning, a lot of times in that open you'll start to get money coming in, and you'll start to get like these big moves happening. So these big impulsive moves will usually happen, or moves that sort of set the tone for the day. Can happen quite commonly in New York. New York and London overlap. So when the guys from London are still trading or doing a bit, and then New York comes online, you can get quite significant movements. Such as this. So decent moves there, decent moves there. They're quite profitable and impulsive moves, so it's quite easy to sort of get into these trades. So say we were looking at a short from this position here. That's 9. We've got a move there. It came back into the area and then it's moved away. So if we had a tight stop loss on there, you can make really good risk to reward. And how you enter, how you actually trade. Obviously, TradingView, you look at it, but there's brokers and different apps, which I'll link in the description, where you can actually start to have a mess about and trade from on demo accounts and things where there's no emotion involved. But it is a lot different, guys and girls, when you're seeing hundreds of pounds popping up and down. Okay. All right. So let's bob back to here. So we've got as main markets Euro, AU, GU, and GJ. There's a number of different markets. Oil, gold over the US dollar, the Dow Jones 30 industrial average and things. They move and you can trade them in similar styles to how you trade Forex. There's the intraday trading, swing and long-term trading, intraday, so within the day, or scalping. We can actually go into real tiny time frames, so each candle represents a minute. Obviously it's not moving now, but we can even go into the seconds and things and start doing trading on mad time frames and taking multiple trades. It's more stressful. The market can just go absolutely nuts, because if you think there's a massive movement of the 15 minutes and you're trying to play ping pong scalping, like play some sort of range thing here, so up and down, up and down. So you're longing and shorting between these things. Yeah, you didn't get that, you got took out. So you have to make sure you have tight stops, but you take a lot more trades, but more wins, more losses. It's pretty much it, and it's more stressful. So scalping is not for everybody. You can even just take out breakout trades and just scalp. So you might enter in, you might take some profit here, and you just made 1 or 2%, then you're in and out for the day. You've made that in a couple of minutes. That's the beauty of it, but it takes a special kind of guy or girl to scalp. Every now and again you'll pop a scalp on, or usually what you do as a trader, you'll have your strategies and your setups and the things you're looking for to tick your rules and enter a trade. And most of what you're doing is just looking at the market and just looking at zones where you might be interested in taking a trade, and then you might get in or you might not. You can put automatic trades on. You can put trades on where you basically set up your own rules. So it's like, if this comes into my zone, right, it doesn't go below here, but then I'll buy the thing as it's moving off. That could be called a buy stop. If there's a buy limit, as soon as it hits the thing, it'd get you in here. You'd still be in, so you could lose, and then it might move off from there. You can have automatic take profits, or you can manually take profits. You can manually get in the market. So this is reality of trading, and you'll usually do that on most brokers, and things are lined up with MT4, so you can get on and use that. Okay, sweet. Any questions? I'll just have a really quick look, see if there's anything else to go through. Yeah, so there's different sessions. The overlap between London and New York is where the most money is coming into the markets, and a lot of times you'll see big moves, or you'll see the move for the day at certain times. Yeah, okay, I think I'll do it.